Hey, what's up, everybody? Cam Hemphill here, your host of the Medical Millionaire Podcast. Thank you so much for taking the time to tune in. My goal is to give incredible value and strategic advisement for every single practice owner. Guys, I've had so many people on lately, practice owners, tech companies, tremendous amount of innovation, talking about private equity, talking about all sorts of strategies and how you guys can grow your practice, how you can elevate, how you become the best version of yourself when it comes to really running your practice like a business and generating generational wealth and creating enterprise value. And so as we continue on these conversations, I have had some great just offline conversations with guests. And today I'm bringing in an expert and we're going to talk about taxes, right? And it's like, I think it's that topic almost like nobody likes to talk about, but at the same time, if you're trying to optimize performance, if you're trying to optimize your wealth, if you're trying to create an asset, you consistently are always focusing on revenue, you're focusing on new patients, marketing, everything that it takes to operate the practice. But then there's always the books, right? There's the books, the taxes, we all file, we have to deal with the IRS, we have to pay taxes. It's just part of the process. And, it's important that you have experts in your team. And so today I have Alexis Gallati. She is the founder of Cerebral Tax Advisors. We've had some great conversations and, she's worked with many practices. Her husband's a neurosurgeon. She works with his clinic and she has a tremendous amount of expertise when it comes to helping optimize tax performance. And so, Alexis, thank you so much for joining. Welcome to the show.
Thank you for having me, Cam. Excited to be here.
So let's jump right in and talk about this. Look, I have had tons of guests on these episodes and podcasts, and I have always been talking about generational wealth, talking about private equity coming in, talking about processes, talking about how you need an operator in your practice. But I think I've had very few tax advisors on the show. And it's a big topic, right? We're always looking to generate profits. We're always looking to optimize patient outcomes. But at the end of the day, this is a business. We have to pay taxes. We have to be strategic about it. So talk to us about that. I know that everybody has a CPA. Everybody talks about taxes. We all have to file, but very few people talk about the strategy. So to you, like, what is the difference? How do you prepare? Talk to us about that.
Yeah. So most of us end up having as you mentioned, like a CPA or a tax preparer, and they really are just recording your history, what you've done in the past, and they're not actually optimizing for the future. And that's really what a tax strategist is. I always joke that I live in 3 different years. I live in last year, this year, and the next year. And so working with the strategist, all 3 of those years are really important. I mean, it's even important looking, 3 to 5 years down the road, especially if you're potentially going to be selling, because there are things that you have to do now in order to set you up for success for later. Or even if you're starting a brand new practice, you got to make sure that you're setting things up properly. So that's what tax strategist does. And most CPAs, most enrolled agents or other tax preparers, they're not thinking about this year and next year, outside maybe some small things that they'll tell you at the very end of doing your last year's return, like, maybe, do a little bit more expenses here, or here are your quarterly estimates there. But they're not going into deep planning to really move the needle.
Mm-hmm. I would agree with you. Look, and I can build on that from my own personal experience. I have had many businesses. I have had numerous CPAs, numerous bookkeepers. Honestly, I got to the point where I got so frustrated, I just figured out how to use QuickBooks myself and became an administrator for QuickBooks in a weird way. But I couldn't for the life of me find out, what is the strategy, right? You can go to QuickBooks, you can connect the bank accounts, you have, the banking that you can obviously do the matching, right? You do the matching, the expenses come in, the cash flow comes in, all the revenue comes in and you can match it and you can do classes and all that stuff. And I won't bore you guys with QuickBooks, and it's not something that I do professionally, but I actually manage my own books. I manage my own books. I have all my classes, everything set up. I have real estate. So, a lot of the audience knows that, that I understand finance at a high level. And, what I found outside of that was a CPA. And I felt like a lot of times I would ask my CPA questions, questions of, well, how do we save here? What's the strategy? Or what do I have to do? And we'd have these quarterly meetings, right? Like, let's make sure to have the quarterly meeting and plan ahead before. And you'd always hear that. So it's like, okay, well, let's go down that path. And I had CPAs at large firms, small firms. And eventually I'm like, look, where's the true strategist here? Somebody that understands how to actually offset, your ordinary income. Okay. And you're the expert, right? But there is true strategy there. And I think from a medical aesthetics practice and provider specifically, you have equipment. They're always purchasing laser equipment, right? And there's bonus depreciation there. The real estate, right? How do you optimize the depreciation there? So I guess my question is when do successful entrepreneurs, primarily medical aesthetics practice owners, realize they've outgrown their accountant?
When they have a gut feeling they're leaving money on the table. And, sometimes you might not see that for a couple of years. You might not see that. Maybe you'll see it right away. But, you really have to see, okay, I'm paying this much in tax. Why are the Warren Buffetts and the Bill Gates of the world only paying 15% tax or sometimes 0% in tax? And that's really what launched me into going down the tax planning route and doing strategies because of my own personal situation with my physician husband. And so it's really when you start to scale and you're seeing, that you're making all this money, but the deductions aren't really there anymore besides your normal, stuff, unless you're out there buying like a new laser or new other pieces of equipment every single year just to make up some sort of deductions. That's when you really want to start maybe just interviewing, going and talking to strategists, those that specialize in tax planning, just to see what they would be able to offer, what sort of strategies, and see if you're comfortable with them as well. Then that way you at least know you have options. And if you're like, you know what, that stuff's really not for me, I guess all I really need is a tax preparer, then okay, go that route. But I'm 99.9% positive that you'll find the value in working with somebody that has that strategic foresight.
Yeah. Is that because you have access to like certain, just the understanding of the IRS code or the understanding of deals out there? Here's why I ask. I talk to my tax strategist all the time. We play golf together, right? He's amazing. He always has like a deal. There's a lot of bonus appreciation at gas stations and acquiring real estate. There's a reason why I have a lot of real estate. I'm a high income producer and I buy real estate to offset ordinary income. Like I bonus depreciate it. Now, if you go sell it, you got to recapture. There's that whole thing. Again, I'm not the professional, you are, but there's a reason why I talk to him a lot more than the person that's filing the taxes, right? So it's like, keep your books organized. You obviously have to file, but the strategy, right? And if I'm a practice owner, and I'm just thinking through the lens of being a practice owner, I work with lots of them. I'm making money. Let's just say I'm making money. I'm doing, let's just say 5 million a year top line. We got, 20% is going to the net income. We're making $1 million, right? Like, you're going to have a tax bill there, right? So for somebody of that profile, okay, that profile that wants to preserve wealth, what are some ideas that they could do to help offset that ordinary income? And maybe you could talk to us a little bit about the ordinary income versus passive, those types of things.
Yeah, definitely. So that net income, that $1 million in net income that you're getting, that's ordinary income. So as a business owner, you have to think of it. It's like the same sort of income bucket as like a W-2. So it's obviously treated differently, but it's going to be subject to those same tax rates. And so you have to look at your entity structure. That's really the first spot that I look. Okay, what type of entity are you? Are you just a single member LLC? Are you an S corporation, a C corporation, or if you have partners, maybe a partnership? Or and also depends too on what state you're in as well. So I'm in Tennessee, for example, and S corporations aren't desirable because Tennessee does not recognize S corporations. So they treat us like C corps, and we're subject to a 6.5% franchise and excise tax, which essentially eliminates the federal benefit of being an S corp. And for those that don't understand how those are taxed, if you look at like a sole proprietorship, for example, or a single member LLC, 100% of your taxes are, 100% of your profit are subject to self-employment tax. So that's Social Security and Medicare. Where in an S corporation, you are taxed, your earnings are allocated between W-2, which is subject to Social Security and Medicare, and then profit. And that profit is not subject to Social Security and Medicare. So that's where you get a federal tax savings. And so Tennessee, being Tennessee, and there's other states as well that do this, they don't recognize it. So we end up having to not choose S corporations in Tennessee. Or even if like you're in California, for example, you are a licensed medical professional, you have to be a PC. And so professional corporation. And then you have to choose to be an S corp or a C corp. So you can't just be an LLC. They don't recognize it. So a single PLLC, excuse me. So that entity structure is that first step in tax savings. And so having a deep knowledge of not only how those entities are structured and how they're taxed, but also taxed at the state level is really important. And then retirement is my next go-to. I mean, that is like a low-hanging fruit when it comes to tax savings and wealth generation. Especially if it's a pre-tax, you're getting a deduction through the business, and then you're also putting that aside. It's growing tax-free, and then you're able to generate that wealth and build, especially if you're younger, over a longer period of time. Love 401ks, love cash balance plans, doing your backdoor Roth, your mega backdoor Roth, all the things. So you have options on a pre-tax and a post-tax level. And then you really start getting into trying to move as many personal expenses to being legitimate business deductions as possible. Classic things like your office in the home or your vehicle expenses, hiring your kids, hiring even parents as well if you're supporting them. And then, really trying to maximize your expenses. If you have your computer and you're using it, but you have to go and purchase Adobe as a software. Well, purchasing that software is deductible. So like these are all very classic, very basic things that you'd be surprised a lot of first-time business owners just aren't aware of that they could be doing. And then you start getting into more of the other classic business deductions, like you said, equipment, and how to optimize that equipment, and also real estate. And if you're able to purchase the building that you have your practice in, and you can do a Section 469 grouping election. So if there's similar ownership between the business and the building, then you're essentially able to change that any sort of losses that occur through your real estate LLC to being active against your ordinary income, where not classically, but normally by default, those sort of rental businesses, obviously you're going to have your rental property, your medical building in an LLC by itself, so you have your rental LLC, normally that activity is considered passive activity. And so what that means is you're not able, if there is a loss, you're not able to take that loss against your ordinary income, from your business, for example, or a spouse's W-2, because it's passive, and that's the rules. And so those losses are suspended and carried forward. And so that you either have passive income to put against it, or you sell the property. So you're not really getting a current year benefit from it. And, ideally, if you go to purchase that property, you want to set it up in the correct way so you can take advantage of recharacterizing those losses from being passive to active. I'm sure I just, gave you way too much.
Yeah, no.
And I love getting into the nitty gritty details, but hopefully that gives at least a good idea and a good picture of just scratching the surface on different types of strategies that you can do from the very beginning, and why it's so important to work with a strategist from the very beginning, or even if you've been in business for a while, starting with someone as soon as possible, so you can take advantage of those tax strategies as early as possible, so you're getting that savings, and that savings can compound year after year.
No, I think I love that you got into it from that angle. In fact, the way that I received that, it sounds like start at the foundation, right? Make sure you're structured correctly from an entity standpoint. And now it sounds like based upon the state, things can be different. I had no idea that was the case for Tennessee. I would never have thought Tennessee would have that based upon where they are from a political standpoint. But it's like Florida. I live in Florida, right? There is no state income tax here. Our property taxes are higher. Our insurance is outrageous. So there's like an offset there, I would say. In fact, they're looking into to reduce the property taxes. There's big things going on there. But make sure you're set up correctly, right? And I think to build on what you're saying, um, if you're an S corp, right, traditionally, maybe outside of Tennessee, you can take that W-2 income and you're paying your ordinary income on there, right? But then as you do, a distribution, it's taxed at a lower level. Is that right?
So that's actually a very common misconception. So distributions are actually not taxable as long as you don't go over your basis, which I can talk about basis in a moment. But it's actually the profit what's taxable. So you can, let's say if you have an S corporation, you can have $100,000 W-2 and a profit of 500,000. But if you don't take any money out of the business as distributions above and beyond your W-2 salary, you're still paying tax on that 500,000 profit. Now, let's say that um, take $20,000 out as distribution, you still have that 500,000 of profit. You're just paying tax on the $500,000 of profit. You don't pay tax on the 20,000 of distribution.
Yeah, that makes it all has to do with the basis. Talk to us about what is basis.
Yeah, basis in a nutshell is what you've put in, what you've put into the business, earned in the business, and taken out of the business. So it's calculated differently depending upon what structure you have. But again, like for an S corporation, if you start a brand new business and you put in $100,000 into that business, but you earn nothing that year. It's your first year, you just break even. But you go and take a loan, or not a loan, excuse me, you take a distribution out of 20,000. Well, you're not going to be taxed on that 20,000. But let's say that you put in 100,000 and you take a loan of 200,000. Now that loan isn't considered income to the business, but you then go and take let's say a distribution of 150,000. Now, technically you only have 100,000 in there. So you've just taken out 50,000 more than you've put in or earned in the business. So you would owe what's called excess distribution long-term capital gains tax on that 50,000. So it's really important to be keeping track of your basis, like what you've put in, what you've earned, what you've taken out, to make sure that you're not taking too much out. And in most cases, that doesn't happen for most individuals. But again, it's something you have to keep track of. Actually, the IRS requires as well that, at least for S corporations, that you keep track of that basis too, and that you have to actually put it on your tax return.
Well, how do you track your basis? Is it like the accounting software you have? Is it a balance sheet thing? Is it a P&L thing?
Yeah, so I mean, we do that for all of our clients. We track that, but yeah, you want to keep track of it. Usually, your software should have that. Unfortunately, I'm not familiar up to date on like TurboTax and some of those other do-it-yourself programs, but that you could even be keeping track of it on your on like Excel. And so, you could probably even go into Chat GPT and say, hey, give me create an Excel worksheet for me to calculate the basis in my S corporation or partnership, or, however much. And so then it'll create that for you, and hopefully it's correct. That's what working with a tax expert is helpful with, to make sure that ChatGPT isn't hallucinating. But assuming it's correct, then you can just do it even in Excel on an annual basis.
And you said something earlier about a backdoor Roth IRA, and then a mega backdoor Roth IRA, because you said, hey, get set up correctly. So I think for the audience takeaway, make sure you guys are set up correctly to get the most benefit, right? I think there's a lot of opportunity there to make sure you actually have the right entity. It sounds like that's step one. Would you agree with that? Does that seem right? Step one,
Exactly. Yeah.
set up correctly, and then you have retirement, like you were building on. There's 401ks, there's IRAs, Roth IRAs, but backdoor. You said backdoor mega Roth IRA. What does that mean?
Yeah. So there are actually two different types of strategies. So the backdoor Roth IRA is for those that want to contribute to their Roth IRA every year, but they make too much money. I believe this year it's about 150,000. So if you make over 150,000 of income, then you can't do a direct Roth IRA contribution. So that means that $7,500 per person. And if you're under 50, if you're over 50, then it's 8,500. So you get an extra $1,000. So with the backdoor Roth, what you're able to do is you contribute that $7,500 to your traditional pre-tax IRA. But since you make too much money, you're not allowed to deduct that $7,500 on your tax return. So essentially, you're putting post-tax dollars into a pre-tax account. So what you do then is you then convert that $7,500 from that pre-tax traditional IRA to a post-tax Roth IRA, and it's tax-free because you have basically converted post-tax dollars to post-tax dollars. So that's the backdoor way of getting it into your Roth IRA.
Okay, so essentially you can contribute to the IRA, right? Because you don't phase out, but you can't participate if you make too much money. You can't participate in a Roth, but you can put it in an account and then do some sort of paperwork or documentation and have it convert to another account. Is that right?
Correct. Yeah, it's super easy. So like you can even go, let's say, to Fidelity, and you open a traditional IRA and a Roth IRA. And so once you've opened up that traditional IRA, you put in the, like for this year, for 2026, it's $7,500. You put in the $7,500. And then as soon as that clears, you immediately roll it over to the Roth IRA. And you want to try to do that as quickly as possible, because you don't want the funds to earn any money before you convert it, because then anything that you do earn would be taxable. So most of the time, even if it's a day or two, you're going to end up getting like 10 cents or something of interest, but that doesn't matter. But if you have it sitting there for, half a year, then, you might earn $200, and so that when you go to roll over the $7,700 with that earnings, you have to pay tax on $200
Do you pay that tax up front or when you file, or how does that
when you file.
when you
Yeah.
file? Okay. Okay.
Yeah, exactly. And you have to make sure that you're reporting it all properly on Form 8606. So there's steps involved, and you also have to make sure that you don't have any balances in your pre-tax IRAs. So that means traditional IRAs, simple IRAs, SEP IRAs as well. Otherwise, you come into contact with what's called pro rata rules. And so a portion of your your conversion from your pre-tax IRA to your Roth IRA will be taxable again. So then you're being taxed on a portion of it twice. And that's why I never recommend like simple IRAs or SEP IRAs for businesses. I'm a 401k girl and a defined benefit plan girl.
Talk to us about that, the 401k.
Yeah. So the 401k really acts very similar to like a SEP IRA, but it's not subject to the pro rata rules. And unlike a SEP IRA, the 401k has two components. It has an employee deferral and an employer contribution. And so the employee deferral, many of you are probably used to, like if you have a W-2 job, you hear about it, that's the portion, like, so for this year, that $24,500 if you're under 50. So if that's the maximum amount that you can put into your 401k as your employee deferral. So that's the amount you'll see come out of your, your W-2, help lower your W-2. Then there's the employer contribution, which is actually a contribution from the business. And so that, if let's say you're an S corporation, that's generally about 25% of your compensation. Again, the full amount that you're allowed to do, employee and employer, is the $72,000 for 2026. And that changes every year. So make sure that you're, like, if you're thinking about doing this for 2025, you actually, and you haven't filed your returns, you still have time to open and fund for that retirement plan until the filing of your tax return, or October 15th or September 15th, depending upon if it's a Schedule C or an S Corp. So that's why when talking about taxes, it's like, well, it depends, because it depends on so many different factors. And but I really like the 401k because it allows you to do that backdoor Roth, that normal backdoor Roth with your individual IRA. And also, too, if you have your 401k, you can have the proper provisions in your 401k agreement to allow you to do a mega backdoor Roth 401k. So you have your traditional, normal backdoor Roth IRA, which is associated with your individual retirement account. So those are yours. Those are for you as the individual. Even if you didn't own a business, you can have an individual IRA. Now, but if you have a business, then you'll have your 401k, which is a business plan, or, SEP IRA is a business plan, simple IRA is a business plan. But that 401k, you can also do your mega backdoor Roth in there if you're not able to contribute up to the $72,000 all pre-tax. So let's say you have a salary of $100,000, then you say, hey, I want to max out my retirement for my 401k. Well, so if it's at 100,000, the max you can do as an employer contribution is 25%, assuming this is an S Corp. So that's $25,000. And then you can do the employee deferral, which is $24,500. And so altogether, you're with that $100,000 of W-2 earnings through your S Corp, you can put away $49,500. If you subtract that from the $72,000, then you have an additional $22,500 that you could put into your Roth 401k as a backdoor Roth contribution in your 401k.
Okay.
So it's
I
nice.
got you.
You can do pre-tax, you can do
Yeah.
post-tax. It's really nice. Now, let's say you only give yourself a salary of 50,000. Then the max you can put away is up to that 50,000 pre-tax and post-tax with that same calculation for an S corp.
Mm-hmm. Now, when you put it all into the 401k, does that help offset, the amount of taxes that you're paying, or
Pre-tax does.
the
Yep. So
pre-tax?
that's a deduction for the business.
Okay.
Yep. And so if you are like, hey, I earned 100,000, but yeah, cool. Like I'm going to max out my 401k pre-tax and post-tax, but I really want to put away more than $72,000. Then that's when you start looking at a cash balance plan, which is a type of defined benefit plan. And so the IRS is defining the benefit that you receive by the time that you retire, which right now is $4 million. That's the max you can do, but it changes every year with inflation. So what an actuary does on an annual basis is they calculate how much you can put in this year based on how much you make, how old you are, and the balance of the account at the end of the year. And so, assuming a consistent rate of growth, like I said, they kind of do backwards calculation to say, okay, Cam can put in this much this year, assuming a consistent rate of growth to reach that 4 million by the designated retirement age. Let's say it's like 65. So these are much, much more complicated retirement plans. But let's say you're 40 years old and you have $100,000 of compensation. I mean, you're easily able to put away well into the six figures. I mean, usually something like that, you're looking at 100, 150,000 a year. If you're older, let's say you're 50, I mean, you're probably looking almost like 200,000 or more. So it really provides you, and that's all pre-tax, I should mention. So that's all a deduction for the business. So that's why I love these sort of plans, because it really gives you the flexibility to put more away into retirement. But then if, let's say you're like, hey, you know what, I'm going to be buying my medical building this year for my practice, then you can freeze the plan for a year, so that it gives you that cash flow, or you can do the minimum as opposed to like the maximum or the recommended amount. And so again, there's a lot of education that goes into it, and obviously crunching the numbers to make sure there is a good cost benefit. But it's a wonderful tool, especially for wealth generation and tax savings.
That's very interesting. I think there's different levels to it. Like you mentioned, it really kind of depends on exactly how much you're looking to put away, and kind of what your roadmap is based upon how you see yourself in retirement. I think it's all kind of goes back to what you were initially saying, is setting up the plan properly, running the numbers, doing the math, and just making sure that you have that roadmap. And I think a lot of people, they fail to make that mistake. I think that we think, oh, we're going to just, work forever and keep making good money. And most of us just don't save at all, or prepare. Right. And I think that's what's going to put you in a position to have an interesting life after a specific age. And so it's important to prepare. Now, you mentioned another component that I thought was really nice was the kids, right? You said you could have your kids work for you. How does somebody go about that?
Yeah, so the court tested age is 7. So at least for my clients, I don't
7.
recommend. Yeah, I don't recommend that they hire their kids until at least that age. Now, if you want to, do the thing, the modeling thing, strategy that's so old and antiquated at this point, especially now that it's good cameras are so inexpensive, and et cetera, that you can pay them like a one-time amount, for those pictures on your website, et cetera, when they're younger than 7. But man, once they hit 7, those kids need to get to work. And so that they can earn their $7,500 at minimum, So then they can go and put that money into their Roth IRA. And then since they don't make as much as you do, what's happening is you're shifting that money from your higher tax bracket down to their non-existent tax bracket. And you can then, so they're not paying any tax on it. You're then going and putting that money into their Roth IRA directly. So they don't need to do backdoor Roth because they're not earning as much money as you do.
Okay.
But they can just do direct Roth IRA contribution. And, if you start them at 7 and let's just say, that amount doesn't change for the next 10 years, like so once they hit 18, then you're able that you just leave it alone. Don't tell them that they have it. That's easily going to be, you're going to be able to go and put that money, or that's going to, excuse me, sorry, that money will be able to grow well into millions of dollars. Like it's going to be at least $2-3 million by the time that they're age 65. So it's a nice little leg up for your kids. And, you're starting to teach them as well about responsibility. So like when they're younger, like they're 7, 8 years old, they may be doing basic things like helping to clean your office or, sweeping, in your clinic area. They're able to help with filing different, folders or things like that. There's a lot of smaller admin things that can be done. But as they get older, they can be helping with QuickBooks or doing, digital filing for you or helping with the website.
Social media. I mean,
social media. Exactly. I have 4 children myself and, ages 8 to 14. I mean, my 14-year-old's learning QuickBooks. And so that's going to be a valuable skill for him. And so you just have to make sure that they are doing a legitimate job. You have to treat them like any other employee. They have to be on your payroll and they have to be going and keeping track of the time and the jobs that they're doing. Having a job description for them, you're signing for them as a minor for the employment agreement, the whole works. And if you have a sole proprietorship or you have a partnership, what's great is you don't even have to pay Social Security and Medicare tax on your child's payroll as well. So that's an opportunity there for those types of entity structures as long as they're 17 and under.
Okay. Well, I mean, I love that. So there's multiple job descriptions they can do. Let's just take the S Corp profile. You probably set them up as W-2 earners through your payroll processing. And okay. And then does that money hit their bank account from the payroll, and then you fund it into the Roth or the IRA, the retirement account?
You got it. Yep. So like for my kids, each one of them has their own bank account. Their paycheck goes directly into that bank account and it just sits there until I've reached the $7,500 and I go and contribute that amount before April 15th.
Okay, gotcha. Would it make more sense to have it go from the bank account to the brokerage account to invest, let's say, into the IRA on a monthly basis, so maybe you're capturing that compounding interest over time?
Yep. Yeah, that's completely fine. Just as long as you don't go over the $7,500 and you make sure that your child actually earned $7,500 as well.
Yeah, let's talk about that, right? So you have to have some sort of agreement. I mean, they're a legit employee. You're paying them a W-2 wage. They are on the payroll, right? So I mean, they have to contribute to the business. Probably some sort of an agreement that both sign, and maybe the job description changes over time, right?
Yep, exactly. So I mean, you can even use ChatGPT to help create that job description to say, hey, my kid's going to be doing X, Y, and Z. Create a job description for this type of business, for it's like a MedSpa, and here are the things that they're doing within it, and then you just put that aside in case the IRS asks for it. 99% of any fight with the IRS or any sort of scrutiny is going to come down to that documentation. So having that available like that is going to be really important if they were to challenge anything.
I see. Yeah. Okay. Now, when you set up are they 401ks or IRAs for the kids?
Those are Roth IRAs.
Roth IRAs.
Yep.
Okay. So when you set
Yep.
up the Roth IRA, it's in their name, right? When you set that up.
Correct. Yeah. It's usually, like a minor account. It just depends on, yeah, it depends on what am I thinking? Brokerage for house you're using. They call it different things.
Sure. Okay. And
Yeah.
a practice owner or a strategist could help them get established with a brokerage account or a wealth advisor or something like that to make
You can
sure
just,
that that's flowed correctly.
yeah, you can just do that yourself. That's
Mm.
easy enough. Where again, like I say, you just go to Fidelity and you can open up a Roth IRA for a minor child, and then you can link the bank account and just when before April 15th, you just got to make sure to move the money over and earmark it for the correct year.
That's perfect. I love it. I think that's huge, and I think it's important that it does something more than just tax strategy too. I think, like, to your point, it builds responsibility, kind of keeps them connected to what you have going on, puts them in a position to obviously get very well rewarded at the age of 18, and then they can roll it over to their personal account as they go forward, and they're no longer a minor. They can manage it. Hopefully, by then they also have great discipline that they don't try to pull it out and continue to build. Right.
Exactly. Yes. Yeah. Just don't tell them about it.
I think that that's appropriate. Maybe 18 is too early. Maybe you want
It is.
to delay that a little bit. I remember at 18, I don't think I was making the best financial choices, I would say. But I think it's a wonderful path. Now let's just get a little bit more advanced. Let's talk about some equipment, right? Because lasers are expensive. I don't know what the current tax code is on equipment, but I think there's a ton of benefit there, right? I mean, I know lasers that cost $200,000-$300,000 in this space, and they produce a tremendous amount of revenue. So talk to us about how can one take advantage of equipment to offset ordinary income.
Yeah. Well, as you said, if you're spending, whether it's $1,000 all the way up to 200, 300,000, however much, what's great is that you can use Section 179 to write it off, or even bonus depreciation, which now with the One Big Beautiful bill got permanently put into place at 100%. So even if um, you know, for some reason forget to do the bonus depreciation, you can just do the Section 179, and there is a limit to the Section 179, but it's very high. It's I apologize, I can't remember off the top of my head, but
Have they increased it lately? Did they increase it?
yeah, it goes and increases. I believe they have a provision now that makes it increase every year for inflation, but Section 170.
And then the bonus depreciation, I remember, because it's 100% now. They changed that with the big beautiful bill. It did like drop down every year. It was like 100, then 75, then 50, then or something. It was phasing. They were phasing it out.
Before, yeah, exactly. But now they've gone and extended that. So for 2026, at least, the Section 179 threshold is the maximum deduction limit is 2.56 million. So
Oh, yeah, sorry.
don't go too crazy with all of your spending, guys.
So, okay, let's just take a real life example. I go buy a 300,000 beautiful the Chanel Saiton, for example, and it's I want to offset it. I want to bonus it out or 179 it out. How does that work? How does that take place?
Sure. So you need to put that onto your depreciation schedule. So you need that asset. It won't be just automatically expensed in, on like your P&L. What you have to do is actually put it on your balance sheet as an asset, because honestly, you want to keep track of it as well, because someday you might replace it. So you want to keep track of it. And, when you bought it, the brand, the model, anything that just makes sure you can easily identify it. And then you will tell your tax software, hey, I want to Section 179 this. And usually there's a button or something like that you just press, and then it'll just show up on your depreciation on your P&L, on your profit and loss statement as a depreciation expense.
Okay.
Yeah.
So let's just do the math. I make $1 million this year. I buy a $300,000 piece of equipment, and I want to use the Section 179. How does that? What does the net result look like?
Yep. Then if it's $1 million revenue and your only expense is that piece of equipment at 300, then you have net income of 700,000.
So you're paying taxes on 700,000, not $1 million. Okay. And so how much would that save you in taxes?
Well, again, it depends on what sort of entity structure you are, but let's just say that, if it's saving you, if you're at 300,000 and you're in the 30, or say 40 with state tax, 40% bracket, then that's about approximately 120,000 in savings, rough numbers.
That's a lot of money.
Yeah, it is. Yeah. And you want to make sure, though, that when you're buying those large pieces of equipment, you're not letting the tax tail wag the dog. Don't just buy a piece of equipment for a deduction, because it's a deduction that's lowering your taxable income. It is not a credit that's lowering your taxes. So it's not a one for one. So if you're spending 300,000, you're not getting 300,000 off of your tax liability. You're only getting about 120,000.
Yeah,
So
it reduces the income. It's not a dollar for dollar. I think that's where a lot of people get confused.
yes, exactly. So don't buy something for the sake of buying something. I say the same thing about vehicles. Don't buy a vehicle for the sake of buying the vehicle. Buy it because you need it. And, and if that's, if you're looking to expand your offerings, then great, buy that. But you also have to realize it's going to take a little bit of time for that piece of equipment to start making you money, because there's time you have to get trained on, and then getting marketing out there, getting customers in. So there's a time lag with the ROI on that piece of equipment.
Yeah, I'd hate for them to buy that piece of equipment just for tax deduction and then not make any revenue on it and have it sit and collect dust. That would not be a good strategy.
Exactly. Yep. Yeah. Exactly.
Yeah.
And then then another surprise that people usually have is, oh yeah, you know what? I saved these taxes, but now I'm cash poor. Like I don't have any cash to run the business or buy something else, or supplies. So you have to make sure that you're looking at your cash flow as well before making that purchase, especially like at the end of the year, if you're trying to lower your taxable liability. So there's multiple factors involved, and that's really another advantage of working with a tax strategist. That yes, we're looking at the tax side, but we're looking at all the other areas of the finances to make sure that you're not, getting cash poor as well. Looking at that cash flow.
Why real estate? I mean, the cars. If look, I obviously completely agree with you. Don't buy a car just to buy a car. I mean, make sure there's a use for it. But real estate always seems to be an important vehicle to use to offset ordinary income, bonus depreciation. I think something was changed there with the big beautiful bill recently. I'm not sure, you would know, but why? Let's just say I'm a practice owner and I'm thinking about buying a building. You mentioned something earlier about how you could lease the building to the business. You can offset ordinary income. Ordinary income is taxed higher than passive income. I know this is getting advanced, but you talked about it earlier. There's a lot of practices out there that do own their buildings, and maybe they have not set up this marriage correctly with the asset of the building and the business. How does that work?
Yeah. So when you have your practice and then you own the building that your practice is in, there is something called Section 469 grouping elections. And this allows you to essentially treat your real estate business, your real estate LLC that holds your building, the same as your active clinical practice. So if you don't do that election, then any sort of losses that occur at the real estate LLC level, you don't get to use those losses in the current year. They are suspended until you, again, either have passive income to put against it or you sell the property. So you're not losing the losses. It's just they're being moved to a future year. So there are obviously criteria to qualifying for that election. Like I mentioned, it has to be substantially the same ownership. And sometimes too, if you have other tenants in the building, so maybe you use 3/4 of the building, but then the other quarter is used by another business, then that can sometimes make it a little more complicated and we might not qualify for it. So there's certain hoops you got to jump through in order to set things up properly and make sure that you can take advantage of it. But the beauty of it is that if you can take advantage of it and do like a cost segregation study where you accelerate the depreciation, then you're able to take like a nice big chunk, get a nice big deduction in the year you do that cost segregation study, and then obviously get nice tax savings and invest that tax savings into something else.
Yeah, I think that's why, I hear so many people that are buying, high income producers, that, they buy a building that obviously that they have their practice in. They also buy Airbnbs, right? Where you can do the cost segregation on it, offset the ordinary income, accelerate the bonus depreciation. Yeah, I think that I've heard that several times that it's a nice vehicle. I think I need to have you back on because I want to take it further. I know you're super busy, running out of time here. But look, this is very informative, extremely informative. And guys, for the audience, look, I know that these conversations may not be, the most exciting, right? To me, they actually are exciting because it's ways to preserve wealth. And, professionals like Alexis here understand that code. They've studied the code. They know how it works. And look, for anybody that's tuning in, that's looking for strategies on how to prepare for taxes, not just the accountant that, here's what I don't like. The accountant that sends you this invoice every single month for billable hours that gives you zero value. Like that's what sets me off. Obviously, you need the bookkeeper or somebody that knows how to manage the books, right? That's important. But the accountant that is not giving advice, sends you a bill for nothing, billable hours if you have a question, and just wants to file the taxes with no strategy. Like you are where the road meets of the strategy. Like you sit in the middle, right? Is where the way I look at it. Is that right? You have the bookkeeper, you have the strategist, and then obviously the person that has to file click the button, file it, and sign up on it. For people that want to connect with you, learn more, maybe they want to have a call, hire you professionally. Where's a good place for them to find you, Alexis?
Yeah, going to our website is the best place, and that's www.cerebraltaxadvisors.com. You can also email me directly. It's just alexis@cerebraltaxadvisors.com. Love to have a conversation. I do want to point out that the most important thing when finding a strategist is to make sure you find somebody that knows how to actually implement the strategies properly and report them properly on the tax return. There are a lot of strategists out there that know the concepts and know the strategies, but they don't know how to implement and report properly. And so that's at least, what we do. We take you from A to Z, where, we will, identify the strategies, educate you on those strategies so that you can make an educated decision on which ones you want to move forward with. Then we are white glove done for you. So we will implement those strategies on your behalf and make sure that they're reported properly on your tax returns. So it's make sure when you're interviewing that you say, hey, are you taking me from A to Z, or are you just giving me the ideas? So, yeah, exactly.
That's a good call out, because I definitely have been in that path before, where it's like, yeah, there's strategists out there. They have the concepts, right? I think we I go to the gym or play golf. I feel like all of us have the concepts, have it down, but you have to have the professional that actually knows how to implement the concepts and file it correctly, right? Or maybe they have another CPA firm that they work with or something, that can actually file it or process it. Yeah, I think that's a really good call out. Well, there you guys have it. Go connect with Alexis. Go check out her website. Again, it's Cerebral Tax Advisors. That's CEREBRAL taxadvisors.com. I'll leave it at that. Thank you so much for joining. Until next time, happy injecting.